Good morning. It's Wednesday, the 11th of September, and this is Govindraj Ethiraj, headquartered, broadcasting and streaming from Mumbai, India's financial capital. The take. Car companies like Tata Motors are now cutting prices quite sharply. Now, the price cuts would be fine if the automobile industry was not so reflective of the overall economy. A report just out by Nomura Securities says sales of passenger vehicles or PVs and medium and heavy commercial vehicles or MHCVs are important to gauge cyclical growth in the economy. Passenger vehicles signal a discretionary demand, while medium to heavy commercial vehicles have a strong linkage to overall industrial activity. And now, both passenger vehicles and commercial vehicle sales have disappointed in July and August, Nomura has said. On the other hand, as we've been pointing out, inventories have risen with dealerships from 55 to 60 days to 70 to 75 days. Now, here's the important part. Nomura says the moderation in buying may have been triggered by the fading of post-pandemic pent-up demand, higher interest rates, and the slowdown in government spending thanks to elections, which are, of course, several months behind us now. Now, there is nothing that says why this could immediately reverse. I feel the larger issue is the reading of signals. Companies worldwide appear to have assumed pent-up demand was equal to consistent demand and growth. A small example from the United States, where discount retail chain Big Lots with over 1,300 stores has filed for bankruptcy. The Wall Street Journal says this is the latest retail casualty as consumers have reined in spending after a post-pandemic surge. There are similar reports of spending slowing down in services as well, including travel within and out of the West. You cannot blame companies for being exuberant and betting on a consistent rise in sales. But India's auto sector story seems to be a cautionary tale of too much optimism leading to too much production and then not relenting, despite dealers pushing back for months saying that they were reeling because of huge inventory buildups. While, as always, some car models are doing better than the others, the fact is that there is a slowdown and a generalized one, and notably so at the entry level. Federation of Automobile Dealerships President Manish Raj Singhania told me last week that salary incomes have not risen by the 70% or so car prices have. Average prices for passenger vehicles were at about 6.5 lakhs 4 or 5 years ago. Now that average price is about 11 lakh rupees, he told me. Somewhere in this, there's a pretty large assumption failure that growth would follow a natural momentum. It is in some ways obvious, even in retrospect, that car makers were not really looking at other figures like income and jobs, or even if they were, they did not pay as much attention as they should have. Moreover, they jumped onto the easy-to-believe answers or excuses like heat waves and then heavy rains keeping consumers or customers out of dealerships. India has a surfeit of less relevant data and a scarcity of critical data on a host of factors. Now, I would think that large companies, including car makers, of course, do their own studies and build models of demand based on them. But between the lack of good public data, particularly more real-time data, and the haze that led to car makers not believing in what they should have been seeing in broad daylight, that they pumped out tens of thousands of more cars than they should have. And then there was the stock market. Who wants to be the first to signal to the stock markets that sales could be headed down when stock prices are racing up? Well, obviously no one. While the exuberance in auto sales and its hangover effects may be visible and now may be coming down as well, could this be the case in other consumer-facing industries in India as well? And that brings us to the top stories and themes for the day. The stock market stayed positive but lean on Wall Street. Mutual funds pull in 38,000 crore rupees in August, the second highest ever. China's $6.5 trillion market loss since its 2021 peak. Understanding India's oil import basket as Venezuelan crude makes an entry. And Apple's AI-powered iPhone 16s are not quite here yet.
This is the Core Report with Govindraj Ethiraj.
Markets lean on Wall Street. Indian stock markets rose again on Tuesday as stocks picked up cues from an overnight rally on Wall Street. At closing bell and after the usual and predictable seesawing, the BSE Sensex was up 361 points to 81,921. The Nifty 50 closed up 104 points at 25,041. Monday was a strong showing on Wall Street after the leading indices there bounced back from their worst week in 2024, and stock futures were trading strong overnight as well. CNBC reported that, among others, cloud platform company Oracle, and that's what it's called now, surged about 8% after posting First quarter results that top expectations. Investors are now watching to see the extent of interest rate cuts at the Federal Reserve's September 17th to 18th meeting, which is a week away. Wall Street is also watching out for the Consumer Price Index report that's today and the Producer Price Index tomorrow, according to CNBC, which also added that September is historically a weak month for equities. Mutual funds rake it in. Equity mutual fund schemes pulled in about 38,000 crores in August, a 3% month-on-month increase despite higher volatility. And these inflows were supported by strong collections from both new fund offerings, or NFOs as they're called, as well as an increase in systematic monthly inflows. The August tally is the second highest into equity schemes during a calendar month, according to Business Standard. Analysts told that newspaper that a correction in the markets in early August seems to have encouraged investors to come into the markets rather than, run from it. Last month, inflows through SIPs were again up marginally, but again to a new all-time high of about 23,500 crores. NFOs in popular categories also did well. Equity mutual funds have collected about 170,000 crores this year. That's this financial year 24-25. And this is already 92% of the total collections of 180,000 crores in all of last year. Total assets under management is about 30 trillion rupees for the first time in August, or 28% rise in 8 months. China stocks under pressure. Some $6.5 trillion has been wiped out from the market value of Chinese and Hong Kong stocks since the peak was reached in 2021. That's almost equal to the size of Japan's equity market, according to Bloomberg. The CSI 300 index, the mainland China index, is now down about 4% in September after a 4-month losing streak. Now, there have been rebounds in China over the past few years. Most have flopped in a matter of weeks as the grim economic reality hit home, according to Bloomberg. The sell-off in these Chinese stocks is also worsening a crisis of confidence in the country's economy, and the CSI 300 is now near the lowest level since January 2019, down almost 7% this year. China is battling with, as we know, the fallouts of a property crisis as well as falling consumer spending, which is linked to it. Interestingly, the benchmarks in the United States, Japan, and India have nearly or more doubled their levels during this period. That's since 2019, while China has lost out. Tata Motors cuts prices. We spoke of how passenger and commercial vehicle sales both disappointed in July and August, quoting Nomura Securities. Wholesale passenger vehicle sales fell about 2% in July, 2.5% in August, and commercial vehicle sales were down 7% in July and almost 11% in August. Inventories of passenger vehicles are now at about 70 to 75 days in August compared to about 55 to 60 in May. Tata Motors yesterday announced massive cuts in the price of its electric vehicles portfolio as part of its Festival of Cars campaign, and the offer will be valid till October 31st, the domestic car maker said in a statement quoted by Money Control. Tata Motors said the move will help in mainstreaming electric vehicles in the country and thus accelerate adoption. Interestingly, Tata Motors has said it's bringing the prices of the best-selling Nexon.EV on par with the petrol or diesel models as well as for a limited time. Now, I would read this also as electric cars not showing the kind of traction they did a year ago or so. Remember, hybrids, for example, are growing faster than electrics. Tata Motors also said customers can enjoy 6 months free of cost charging at any of its 5,500 Tata Power charging points across the country, thus making intra- and intercity journeys free and cost-free, at least for some time. A day ago, Tata Motors also announced discounts of up to 2 lakh rupees on its petrol and diesel variants of cars as part of its Festival of Cars campaign. India's falling oil import bill. India's oil import bill could fall further, but Morgan Stanley now says that low oil prices could also signal a slowdown. It has said that a decline in oil prices could be a cause for concern for Indian equities if the oil market is right about its assessment of a global slowdown, according to the Economic Times. The brokerage said that while falling oil may seem good for India's economy, earnings and shares, in practice the impact depends on the reasons and duration of the fall. Morgan Stanley strategist said in a client note that it is safe to say that the recent bearishness in the oil market is being led by growing concerns about slowing demand, and to that extent, its positive impact on India's terms of trade is diluted greatly. Oil prices have dropped over 10% in the last 2 weeks on demand worries and are currently hovering around $74 a barrel. Morgan Stanley says there is no reason to be more optimistic because oil is down. If anything, if the oil market is right about its concerns about global growth, then we should be worried for absolute share prices, said the brokerage's strategists and quoted by the Economic Times. Interestingly, India's import bill for oil could be lower now than what it was thanks to cheaper Russian oil. A chart published in the Business Standard says the average price per barrel of imports for India in September would be around $75 compared to a peak of $89 in April, also referring to the arrival of cheap Venezuelan crude. Now, India is relying less relatively on Russia and more now on countries like Iraq, as we've mentioned before. And that has, of course, been good for the economy, at least when it comes to prices. I reached out to Narendra Taneja, leading energy expert and also chairman of the Independent Energy Policy Institute. And I began by asking him how he was seeing the current oil import basket and also his outlook on oil prices.
We are heavily dependent on imports, crude. We are importing roughly 88 to 88.5% of total requirement of crude from various geographies. And if you look at, for instance, the current situation, we are importing, if you go by the latest data, roughly 4.8 million barrels of oil per day, every day. 4.8 million barrels. That makes the second largest importer of oil in the world. And if you look at the kind of, mix in terms of geographies, roughly 40% is now coming from Russia of our total requirement. This varies, month to month. Last month, it went down a bit because our refineries were going through, the annual maintenance. So otherwise, if you look at broadly the last few months, it's in the region of 40% of total oil, about 20% from Iraq and 15% from Saudi Aramco, that's Saudi Arabia, and 4% from the US. Of course, it's a major change in terms of, the geographies and the colors and everything, because if you see the situation before Ukraine war happened, we were importing a lot from the Middle East, like 24% was coming from Iraq. And if I remember right, about 16% from Saudi Arabia and almost 10% from the US and only 2%, actually a little less than 2% from Russia. And that changed dramatically, over a few months. And the reason for that was very simple. It was no love for Russia or anything of that sort. It was just that they offered very attractive discounts. So we really don't know the economics of what is that they had negotiated with Russian exporters, but we do know for sure that it was a very attractive economics. And because you just look at their GRM and look at their overall profit, it's very clear that they enjoyed heavy discounts from Russia. So that's the kind of scenario like today. And as I said, oil has no nationality. When you look at it from the viewpoint of a major refiner or major importer like India, so whosoever offers, good discounts, they go to them.
As the Russian prices have increased or the discounts that we were getting are reducing, we are obviously switching to other options, including Iraq that you pointed out. Also, some Venezuelan crude from what I could see. Now, what is the impact of all of this on the cost or the average cost per barrel to India and to Indian refiners?
First of all, Iraq has always been a very important crude for Indian refiners, and it is still number two. It used to be number one before Ukraine, and now it's still number two. So it's actually more important than even Saudi Arabia because the quality of Iraqi oil is very good, and Indian refiners are kind of very comfortable with that. And majority of our refineries are kind of designed in such a way that they refining Iraqi crude more economical. But in terms of discounts and the profit and all that, if you go by numbers which are available in the public domain, like in the last fiscal, the fiscal 2024, we saved roughly between $18 billion. It could be a little bit more. The rough estimate is in the region of about $12 to $16 billion in that fiscal. And this year already, the current fiscal, we have already saved more. And the numbers which are coming out, we probably are going to save much more than what we had in the last fiscal. But as I said, the exact number the refiners don't share.
But you're saying that despite the discounts on Russian crude going down, we are still saving more. So we are getting oil cheaper this year than we got last year or the year before?
Oh, yes, we are getting, because you see, India now has kind of overtaken China. China traditionally has been the biggest importer of Russian crude, and they import by sea and they also have pipelines, as you know. So, but now India has overtaken China. Today, we are actually number one buyer of Russian crude. And that has a lot to do with India's economy. As you know, that India today is the fastest, we see the fastest rate of growth in oil consumption. And at the same time, if you look at large economies of the world, India is most dependent on oil imports than any other economy. And as I said earlier, we rank roughly third in the world in terms of oil consumption and second in terms of oil imports. So it makes India a very attractive country for Russian exporters.
Right. Currently oil prices are low. We are in the $74 barrel region, crude oil. What's your outlook looking ahead in a more global context, particularly in the context of prices?
You see, predicting oil prices is always a very difficult job, but as part of my work, I've been doing it for years now, and I've, rarely been wrong. So my own sense is, if you look at, let's say, next 3 months, 4 months, since we don't see actually kind of any dramatic growth in terms of demand globally. I mean, India is actually the most bright star on the horizon in terms of where you see the growth of demand. But otherwise, the demand in China is going down, America is actually going up, Western countries are not consuming more. And there are a few other bright spots like in the Middle East and in a couple of other geographies. So given that situation where the demand is not going up, and at the same time there are no major or there is no disruption in supply, which means demand and supply fundamentals are in favor of oil prices being low. Geopolitical trigger, which is always a very important factor, when you look at oil prices. Ukraine has been kind of already adjusted by the market. Israel Hamas has also been adjusted, by the market. So we also noticed that, senior Hamas leader was killed in Tehran, but still, Tehran has not really reacted to it in the sense that it seems that Iran is not in favor of any escalation in the Middle East, which is a good news for the oil prices. So my sense is that, oil prices are going to move southward a little bit more, may touch even $70 per barrel. Will not stay there for long because then the OPEC will intervene and they would like to make sure that the prices start moving northward. But when you look at the overall, I think the prices are going to be in the region of about 75 to about $83 per barrel. Of course, I'm talking of Brent because that's the benchmark we use in India. So in that region, so you may see going up to 85, you may also think coming down to 70, but that's kind of short, the next few months. But when you look at the medium to long term, demand for oil is only going to grow and there is not enough investment going in exploration production. And at the same time, global economy is still a fossil fuel economy. 80% energy being consumed on the plant is still coming from fossil fuels. In India, it's more or less the same. Roughly 80% is coming from fossil fuels. So with that kind of landscape and the ground reality, so demand for oil is going to grow. I think India probably will be consuming roughly maybe 7 million barrels or 8 million barrels in coming years from 5.5 million barrels a day today. So which means that demand is only going to grow and the prices will, at the same time, not enough investment is going. Sufficient investment is not going in exploration production. So there will be shortages and the prices. But that's medium to long.
Narendra Taneja, thank you so much for joining me.
Thank you very much.
Apple's first AI phones are not quite here. Apple launched the iPhone 16 and iPhone 16 Pro overnight, but without the Apple Intelligence software, at least when they arrive on September 20th. The devices mostly look like last year's models and cost the same, but with new colors and faster processors, says the Wall Street Journal. The regular iPhone 16 can play video 2 hours more than the regular iPhone 15. And that's what the company's specs claim. The Pro boasts an even bigger jump of 2 to 4 hours, says the Wall Street Journal, adding that the star feature is a new camera control button on all models, letting users quickly access and control the camera. So that's why people buy phones, if you didn't know that already. The button also launches a feature exclusive to the new iPhone's visual intelligence, which identifies and interprets things seen through the camera. The yet-to-be-released AI features or artificial intelligence features, including a smarter Siri and text summarization tools, will be available for the iPhone 15 as well. The WSJ says Apple showcased a revamped Siri that can speak more freely and use personal context to deliver better responses. New writing tools will summarize, rewrite, and proofread text in notes, mail, pages, and other apps. And finally, the iPhone will be able to record and transcribe calls. That was the Core Report with me, Govindraj Ethiraj. Do stay connected with more of our coverage at the Core. You can check out our website or sign up to our newsletter for our exclusive stories, one in-depth feature a day on www.thecore.in. Do also track us on LinkedIn, where we usually post synopses or extracts of our top stories and interviews. We would love your feedback on how we can make business more interesting and relevant, including, of course, India's vibrant manufacturing sector. So write to us at feedback@thecore.in, and thank you once again for listening.